In financial reinforcement learning, the most dangerous move is to try something new. Unlike games or robots, a single bad exploration can wipe out a portfolio. So the optimal strategy is often to stop exploring entirely. Every reinforcement learning agent faces a fundamental trade-off. It can exploit what it already knows to maximize reward, or it can explore new actions to gather information. In a game, exploration might cost a few points. In finance, exploration can mean taking an untested position that loses millions. The asymmetry is brutal. The upside of exploration is uncertain, but the downside is immediate and potentially catastrophic. Reinforcement learning aims to maximize the expected sum of discounted rewards over time. The discount factor gamma determines how much we value future rewards relative to immediate ones. In finance, the reward is typically profit or return, but this objective ignores risk entirely. That is why we need constraints. To make reinforcement learning safe for finance, we add constraints on risk measures like conditional value at risk or maximum drawdown. This turns the problem into a constrained Markov decision process. We maximize the reward while keeping the expected cost below a threshold. The cost function can represent drawdown, volatility, or any other risk metric. Conservative policy optimization is a method that updates the policy while respecting risk constraints. It uses a trust region to ensure the new policy is not too different from the old one, measured by KL divergence. The update maximizes the expected advantage, which is how much better an action is than the average, subject to the cost constraint and the KL constraint. Online exploration means the agent interacts with the live market, trying new actions and observing the consequences. The problem is that financial markets are non-stationary, meaning they change over time, and they are adversarial, meaning other participants may exploit your predictable behavior. A single exploratory trade can move the market against you, and the information gained is often not worth the cost. Offline reinforcement learning completely avoids online exploration. The agent learns from a fixed dataset of historical interactions, which could be past trades, simulated data, or a combination. This eliminates the risk of catastrophic losses during training. The challenge is that the agent must generalize to states and actions not seen in the data, which requires careful regularization. Conservative Q-learning is a popular offline RL algorithm. It modifies the Q-learning objective to penalize overestimation of Q values for actions not seen in the data. This prevents the agent from choosing risky out-of-distribution actions. The loss function includes a term that minimizes Q values under a uniform distribution, and a Bellman error term for the seen data. The contrast between online and offline reinforcement learning is stark. Online RL interacts with the live market, which is risky but can adapt to new conditions. Offline RL trains on historical data, which is safe but may not adapt to regime changes. In finance, the safety of offline RL often outweighs the adaptability of online RL. If online exploration is too dangerous, where can we explore? The answer is simulation. We can build realistic market simulators that mimic price dynamics, order flow, and market impact. Agents can explore freely in this sandbox, learning robust strategies without risking real capital. The trained policy can then be deployed offline or with minimal online adaptation. Implementing safe RL in finance requires careful attention to data quality, feature engineering, and validation. The offline dataset must be representative and diverse. The risk constraints must be calibrated to the institution's risk appetite. And the policy must be backtested rigorously before any live deployment. The exploration-exploitation dilemma is not just a theoretical curiosity, it is a practical constraint that shapes how we build trading systems. Offline reinforcement learning, combined with simulation and strict risk constraints, offers a path to deploy AI in finance without exposing capital to unnecessary risk. As markets evolve, the balance between safety and adaptability will remain a central challenge. We at DeepQuant believe that the most robust strategies are those that respect the asymmetry of risk. Your feedback helps us refine our research and bring you more evidence-driven insights. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.